Yesterday, the stock market bounced, the S&P up about 1%, the Nasdaq nearly 2%, led by the very chips that had just been sold. Relief. But look past the closing bell. The dollar broke out to its highest level since May 2025. A bounce on the screen, a squeeze underneath. Here's the number the crowd is chasing. Morgan Stanley now sees about $570 billion of artificial intelligence-related debt issued this year, roughly 4 times last year's pace. The marginal artificial intelligence dollar is now a borrowed dollar, financed into a hawkish Federal Reserve and a rising dollar. So where's the edge? Not in the bounce, in what funds itself. When the rate squeezes the borrowers and the dollar squeezes the speculators, you own the thing that pays for its own growth. The crowd bought the bounce. The dollar priced the squeeze. This is the asymmetric. This is the asymmetric, issue 21, the squeeze, tech and crypto investing for thoughtful retail from an operator's lens. Last issue, a hawkish new Federal Reserve chair priced the build. This issue is where that price gets paid, not in stocks, but in the dollar and the metals. Here's the one-line read. The Hawks' verdict moved from the headline into the plumbing. Equities took a relief bounce, the S&P up about 1% to 7,500, the Nasdaq up nearly 2, chips leading. But the dollar broke out to about 100.8, its highest since May 2025. Gold was crushed on rising real yields and a stronger dollar, and Bitcoin and Ether slid despite a signed Iran peace. Today, Juneteenth. United States cash markets are closed, so the squeeze is the only tape trading. Own what funds itself, the dollar is squeezing what doesn't. You'll see the same labels throughout. Confidence, high, medium, or low. Consensus versus variant, what the market believes and where we may differ. And on every call, what would change our mind. That's the discipline. Part 1, the macro regime, the bounce, the breakout, and the squeeze underneath. The 30-second frame. 1. Equities bounced, but only the index, the S&P up about 1%, the Nasdaq nearly 2%, chips leading a relief trade off the worst new-chair Federal Reserve day since 1994. 2. The dollar broke out to about 100.8, its highest since May 2025. 3. Gold took the real yield hit, easing to about $4,246 an ounce. 4. Crypto slid as macro beta, Bitcoin towards 63,000, Ether towards 1,700, both lower despite the signed Iran peace. And 5. Oil kept bleeding the war premium, with crude near $76.50 as the Strait of Hormuz reopened. Cash equities are closed today, Friday futures point lower. Start with the tape. This was a relief bounce in the index, not a turn in the regime. The S&P rose about 1% to 7,500, the Nasdaq nearly 2% with semiconductors leading, and the Dow was roughly flat. But the Federal Reserve's verdict didn't change between Wednesday and Thursday, only the most sold names bounced. Meanwhile, the dollar, the curve, and gold all kept pushing in the hawkish direction. When equities rally on relief, while the dollar breaks out and gold is crushed, the stock index is the lagging indicator, and today's holiday closure makes that explicit. Now the dollar, the breakout that does the Federal Reserve squeezing. The dollar index pushed to about 100.8, its highest since May 2025, as the bond market priced a higher for longer, maybe hiking Federal Reserve. The 2-year yield near 4.2%, the 10-year in the high 4.6s. The Federal Reserve sets the rate, the dollar exports the tightening. A breakout to a 13-month high raises the real cost of trillions in dollar debt outside the United States and pressures every asset priced against it. Gold, crypto, emerging markets, and the borrow-to-build layer all at once, without the Federal Reserve lifting a finger between meetings. The assets that fund themselves are insulated. The ones that depend on cheap dollar liquidity are not. Then the squeeze, asset by asset. Gold took the real yield hit, easing to about $4,246 an ounce on rising real yields, and the stronger dollar, the textbook drag on a non-yielding asset. We cite gold by level and driver, never a contested period return. Crypto slid as macro beta, Bitcoin towards 63,000, Ether towards 1,700, both lower despite the signed Iran peace. The tell that crypto trades the dollar and the rate, not the geopolitics. And oil kept bleeding the premium, crude near $76.50, and heading for a weekly loss as the Strait of Hormuz reopened on a 60-day clock. Disinflationary if it holds, though the deal's durability is contested. Part 2, in focus, the self-funding answer to the squeeze. A regime that squeezes the borrowers and the speculators is by the same token a subsidy to whatever funds itself. So our live, filings-grounded workup this week is the opposite of last week's bet on the bill, a profitable, debt-free compounder, TOST, the vertical operating system for restaurants. In the year ended December 2025, TOST grew revenue about 24% to $6.15 billion, and net income inflected from just $19 million a year earlier to $342 million, with $661 million of operating cash flow and no long-term debt. That momentum carried into the first quarter of 2026, revenue up about 22% to $1.63 billion, and net income up about 125% to $126 million. Now the debate. The bull in the numbers, growth that funds its own growth, a low 20s revenue grower with accelerating earnings, rising operating cash flow, and a debt-free balance sheet with over $1 billion in cash. It needs no bond market, no rate cut, and no legislation. It compounds on retained cash. The bear in the numbers. Self-funding is not the same as cheap or immune. The blended gross margin is thin, around 26%, because most revenue is low-margin payment volume, not high-margin software. And it's levered to United States restaurant spending, so a hawkish Federal Reserve that cools the consumer hits the very engine of its growth, and you're paying a growth multiple, not a value one. The read, a research view, not a call. TOST is the listed embodiment of the discipline this regime rewards, a profitable, debt-free, self-funding compounder, the structural opposite of the borrow-to-build layer the hawkish Federal Reserve is taxing and the speculative layer the dollar is squeezing. The honest bear isn't the balance sheet. It's the consumer cycle its payment volume rides and the multiple you pay for it. The balance sheet solves the financing risk, not the demand risk. The havens and crypto took the squeeze straight. Bitcoin towards 63,000, Ether near 1,700, both lower despite the signed Iran peace, trading the dollar, not the geopolitics. But the structural rails story has a hard date attached. The European Union's marketing crypto assets rules end their transitional period on July 1st. Only about 210 of more than 1,200 firms are fully authorized, just 14 with trading platform licenses, and Tether's USDT is shut out, while Circle's USDC and its Euro coin are the compliant survivors. A rails reshuffle that runs on a calendar, not the rate. And the thematic. The squeeze sharpens the self-funding lens, and the build keeps borrowing into it. Morgan Stanley sees about $570 billion of artificial intelligence-related debt issued this year, roughly 4 times last year's pace, as hyperscalers turn to the bond market to fund a build-out tracking towards $700 billion of capital spending. The marginal artificial intelligence dollar is a borrowed dollar into a hawkish Federal Reserve and a breaking out dollar. So own what funds itself and be wary of the borrow-to-build layer and the pure liquidity beta the dollar is squeezing directly. Part 3, the squeeze. The crowd bought the bounce, the dollar priced the squeeze. What we are watching over the next 10 days. Friday's open after the holiday. Does the relief bounce extend or fade? The dollar, does the breakout extend or self-correct? Federal Reserve speakers on whether they validate the roughly 85% odds of a hike by December. Gold against its structural bid. The European crypto cliff on July 1st. The Iran truce, a 60-day test. The pace of artificial intelligence debt issuance. TOST and consumer spending. Bitcoin against the dollar. And Nvidia and the hyperscalers' capital spending. And we keep score in public. TOST enters as the lead self-funding compounder, the listed answer to the squeeze. The dollar, a regime signal. Coinbase, the bet on the bill rails. The Federal Reserve verdict, hawkish. Oracle on financing risk. Nvidia, the self-funding profit center. Micron on sold-out memory. Circle on the settlement rails. Palantir on sovereign artificial intelligence. Gold, constructive. Bitcoin, a liquidity tape. These are dated, falsifiable calls. And we grade them. So where does it land? The Hawks verdict moved into the plumbing, equities bounced, but the dollar broke out, gold was crushed, and crypto slid. The dollar is doing the squeezing, And the asymmetry is owning what funds itself, and this week it has a name, TOST, a profitable debt-free compounder. The crowd bought the bounce. The dollar priced the squeeze. This is research, not personalized advice. Verify it yourself. We'll see you in the next issue.